Omnitech Engineering, by the way. We'll just get that listing going on your screens. But let's welcome on board Abhishek Bansal, the co-founder and CEO at Shadowfax Technologies, to find out how their business has been, given that they're now expanding their network with One NCR. So let's try and understand the business a little bit better. Abhishek, hi, morning. Great to have you on ET Now. Tell me all about this One NCR. It's your largest automated sortation hub structurally. What changes in your network because of this facility?
Thank you for having me here. So One NCR, we went live a couple of weeks back. It is the largest sortation center with a processing capacity of 1 million shipments on a single day. What we are seeing today is in our e-commerce business, we are seeing us gaining rapid market share in the market. We are growing faster than the market. Last quarter, we have grown about 65% year on year. We see a very high growth pace to continue over the next 4 to 8 quarters. And for that, we are setting up a capacity today to basically enable these intercity e-commerce shipments. One NCR is our flagship facility now, single largest facility that we have set up in India. Today, we run about 45 lakh square feet of real estate across the country. One NCR is going to be one of the standout flagship facilities that we will run. What this is going to enable us is to ensure that all the shipments are getting processed within a single facility. We are able to offer some of the best in time tag across the country, and through our facility, we will be having direct 80 connections across the various state capitals and some of the strategic centers having direct truck connections, which typically we call as our mesh network. So having a mesh network enables us to deliver at an incredible speed, and that is something that we believe that the One NCR facility is going to propel us towards.
Very interesting. And Abhishek, with regard to One NCR again, just trying to understand, is this capacity addition, does it change your cost structure fundamentally? Does delivery speed go up? What does it add in terms of capability for you?
It is actually a mix of everything that you just said. It adds phenomenal speed, it adds capacity for us, and having this kind of an automation makes us less dependent on people, which essentially helps us reduce long-term costing. Typically, these kind of projects take about 3 to 4 quarters to reflect in your bottom line. And when they do, they bring in a meaningful impact to your long-term profitability.
And with regard, you've obviously been trying to scale quick commerce. How is that playing out?
So quick commerce is about 20% of our business. We are the single largest third party, which today is serving every quick commerce, every food delivery company in this country today. We have an advantage given the kind of last mile we have set up, where we work with everyone to essentially help them manage their peaks and troughs, help them create very differentiated sort of models for last mile, and create an alternative to the internal supply chain that are getting created. Quick commerce continues to grow really fast for us. It is growing for the market as well. You see newer entrants coming over here every quarter. We are also seeing a lot of meaningful play for third parties like us in the verticalized quick commerce space, as I would call it. Today, it is not just about the top 4 or 5 marketplaces, which are where you will go and shop. We are seeing very specialized marketplaces emerging today, right from baby wear to gourmet food to gourmet grocery. And we believe this trend is going to continue big time. Offline markets that we all have been used to for generations are going to get replicated online through this method of vertical quick commerce. And that is something we believe third party has a huge potential. Companies like this find it really, really difficult to set up their own supply chains. And third-party companies like us have a huge advantage as verticalization in our sector starts happening.
Abhishek, wanted to understand whether you're planning on similar mega automated hubs in other cities as well, and what the capex roadmap is like for the next 2 to 3 years.
Yeah, so that's a great question. We have been planning automation as a big part of our expansion over the next couple of years. As part of our IPO proceeds, roughly about 40-45% of our IPO proceeds will actually go into capacity enhancement and creating this sort of a network automation setup over the next couple of years. Historically, about 55 to 60% of our capex spends has gone into sort center automation. we believe over the next couple of years, roughly about 60 to 70% of our capex is purely going to go into sort centers and network automation. We believe that over the next couple of years, as we continue growing fast, as we continue setting up these capacities, roughly about 3 to 3.5% of our revenues, we will reinvest back into capex across some of the top cities of this country. One NCR is just one of the projects. We believe multiple such opportunities we are going to announce over the next couple of years.
And Abhishek, with regard to insourcing, what are your conversations playing out when it comes to your clients? What are they suggesting? How confident are you of holding on to the business that you've won?
No, I think that's, again, a great point, a great debate about the sector that's historically been there. See, insourcing, if you understand, is a strategic choice a lot of companies take to diversify from 3Ps. Okay, insourcing is not necessarily cost effective, as you would have seen in the respective P&Ls of various companies. What we believe is that some of these insourcing measures, they have been able to diversify well away from 3Ps, where a large part of their business today happens through these insourcing arms from some of the large companies. We believe some of these initiatives have sort of saturated now. We have hit a sort of a steady state where there are a couple of large third-party logistics companies in this country who are doing business. There is a certain percentage of each platform business that is happening through these insourcing arms. We believe next couple of years, there's going to be stability in this sector. And that is something which is going to make all the third-party companies across the sector thrive and perform well.
Abhishek, you're obviously building for optimization, and therefore this margin expansion that you're looking at 100 to 120 odd bips will likely play through. But how is competitive intensity playing out, and how is pricing playing out? Could that at all be a downside risk where margins are concerned and your guidance is concerned?
Well, I'll take both the questions separately. See, if you look at our sector over the next couple of years, see, as you continue growing in logistics, you will get operating leverage. There are multiple levers within our P&L which we can talk about where there is huge operating leverage, be it in terms of transportation cost, fixed cost, last mile cost, or even some sort of other losses kind of a cost where typically as you grow, and we are growing at a very, very fast pace, as you grow, operating leverage kicks in. While we are giving a guidance of 100 to 120 bips on our profitability, we are also promising that we'll continue expanding on capacity, continue opening pin codes. So some of that cost is actually included in our P&L, and even despite that, we'll be delivering a better profitability purely due to operating leverage that is going to come in. Regarding profitability, see, if you again look at our sector has been rapidly consolidating over the last couple of years. As per a recent report by Morgan Stanley, roughly about 75% of the market is captured by two large 3PLs in the country today. And this number is going up probably every quarter. We were at merely 8% market share a couple of years back. Today, we are at about 26% market share. So we see that there is a rapid consolidation that is happening within the market. While our customers want to diversify, they want newer players to come in. But given the complexity of our business, given how this business has been historically built, and the amount and the kind of entry barrier that you have to eventually scale this business, we see there are 2 or 3 large companies which will essentially become large, which means that there is going to be lower competitive intensity on pricing, lower competitive intensity on some of the discounts. Now, if you also compare Chinese parallels to India, in China, what has happened, if you look at the percentage of logistics spent for digital companies versus the GMV, India is sort of very, very close to where China is. So there is little scope or little requirement to reduce prices significantly in our sector for companies or e-commerce companies especially to grow. So we don't see any massive downward pressure coming in our sector, given, there is a fair bit of consolidation that has happened in our sector as well. It gives a very level playing field for everyone to operate in.
Interesting. Okay, great to have you then on the show. Thank you so much for your time today.
Thank you.
Okay, on that note, let's take a very quick break. Just want to revisit where the market is settling in at, while of course we gave up those morning gains. So it's getting a little choppy. And now we're back above, gaining ground. We're again up over 130 odd points in the Nifty futures, 0.5% higher. It's clearly metals as well as the entire defense trade, which is actually leading the market forward. So Vedanta, Hindalco, Mazagon, Nalco, these are your big winners in the markets this morning. Quick break, be right back for more.